they generate $13.15 billion in trailing 12-month free cash flow, page 22. That cash effortlessly services the debt. They don't need a 50-page framework to hand cash to bondholders. Which brings me to my third question about the NLP data. Yes, the 2012 structural break in the MD&A saw the composite Z-score collapse from a positive 1.83 to a negative 1.53, page 23. But this coincided with ROIC rising. Isn't this profound silence simply a shrewd, highly rational legal strategy under the master settlement agreement, rather than a mask for fundamental weakness?
Silence might be a valid legal strategy, but it masks massive tail risks. And this highlights our second investigation gap, which is the unquantified regulatory impact. My third question to you is this. Their hedging language index rose from 0.56 to 0.67 over 3 years, P24. If the FDA successfully implements a menthol ban, which could wipe out 25 to 30% of volumes overnight, how can you justify a margin of safety on a company that outright refuses to quantify that regulatory tail risk? You justify it because the market is already pricing in a worst-case scenario. And here is my fourth question. If you reverse engineer the current market cap using the Penman model, the market's implied perpetual growth rate is negative 0.97%. Page 25. The market expects them to shrink. Given that pessimism, and a 9.5% free cash flow yield offering a 538 basis point spread over the 10-year Treasury, page 26, aren't you just ignoring the massive cash-in-hand premium? I'm not ignoring the cash, I'm questioning its durability. Which brings me to my fourth question. Altria is actively trying to transition to smoke-free products, yet the gap map for business model transition trajectory is at the 0th percentile, page 27. This is our third investigation gap. There is zero smoke-free revenue bridge figures in the footnotes. How can you confidently project cash flows 10 years out when management provides absolutely zero segment data for how they will replace combustible revenue?
Because the legacy combustible cash flow buys them a decade of runway to figure it out. My fifth question challenges your wake trap theory. You say a 1% shift in interest rates ruins the equity, but their free cash flow to net income ratio persistently runs between 129% and 154%. Due to structural non-cash charges, P28. Doesn't that massive liquidity buffer completely negate the standard mathematical sensitivity of a WACC model?
No, it doesn't negate it, because that liquidity buffer is already spoken for. My fifth question focuses on that exact cash output. They are funding a dividend payout ratio of over 100% of net income, P29. This reveals our fourth investigation gap, the lack of a disclosed sustainability framework for the dividend. If volume declines accelerate just slightly, say to 7%, doesn't that payout ratio force a dividend cut or catastrophic borrowing?
It is over 100% of net income, but it is fully covered by free cash flow because of depreciation and amortization. Let me ask my sixth and final question. The machine learning model rejects Altria primarily based on a negative $5 billion book equity, page 30. If we both agree that this specific metric is a mathematical anomaly, an out-of-distribution artifact, isn't your entire bear case simply a misinterpretation of a uniquely optimized capital structure?
Absolutely not. My final question flips that premise. The ML algorithm doesn't just look at the equity. It sees the SG&A deleveraging and the narrative silence. This leads to our fifth investigation gap, which is the true elasticity limit of the marginal smoker. If they are just using complex, long-duration financial engineering to prop up the stock price while the core consumer disappears, how is that a durable compounder and not just a slow-motion liquidation?
I think that framing is overly pessimistic, but I appreciate the rigor. Let's force some precision here and build out a spoken scenario table to see what would actually have to happen operationally for our respective theses to play out. Let's establish a bull, base, and bear scenario, focusing on 2 or 3 key assumptions for each. I'll outline the bull scenario. In this case, combustible volumes decline at the historical base rate of 3 to 4%, but pricing continues to comfortably exceed that. Operationally, we would need to see smoke-free products reach roughly 10% of total revenue by 2028. For evidence, we would need the next 2 quarters of operating income to flip back to positive year-over-year growth, confirming that the SG&A spike was just a temporary transition cost.
Fair enough. I will lay out the bear scenario. Here we assume volumes decline a bit faster, maybe 4 to 5%. Pricing covers the gross margin, but the SG&A deleveraging we've discussed keeps operating income flat or slightly negative. Operationally, they manage to perpetually refinance the debt, but they are forced to do it at 7% coupons, which eats into residual income. The evidence we'd need to confirm this is the SG&A line remaining elevated as a percentage of revenue in the upcoming 10 Qs, proving the lost leverage is permanent.
And what about the bear scenario?
In the bear scenario, volumes drop 6 to 8% annually, perhaps triggered by a regulatory event like an FDA menthol ban or intense consumer macro pressure. Pricing totally fails to offset the volume loss, and operating income drops in the high single digits. To confirm this, we need to see definitive FDA action, followed by management being forced to cut the dividend within the next 24 months to defend the balance sheet.
That provides a very clear roadmap of what we are looking for. Now, a crucial part of our analysis is identifying falsifiable triggers. What specific data points would cause you to abandon your thesis? For me, I have 3 triggers that would change my mind. First, if net operating margins strip below 50% for 2 consecutive fiscal years, that would prove the pricing power is definitively broken. Second, if the interest coverage ratio drops below 8 times, signaling the debt burden is actually restricting operations. And third, if management issues an MD&A that explicitly guides down future cash flows, breaking their pattern of silence to issue a warning.
Those are concrete. From my side, I would change my mind and accept the compounder thesis if I saw these 3 things. 1, if they successfully delever $3 billion in debt from free cash flow without issuing new paper, proving true capital discipline. 2, if they publish a transparent, detailed, smoke-free revenue bridge showing profitable growth rather than just top-line cannibalization. And 3, if operating income grows faster than revenue for 4 straight quarters, definitively disproving my thesis about fixed cost deleveraging.
Possesses an incredibly anomalous capital structure and remains, at least for now, a staggering cash-generating machine. But the open risks are substantial. My position remains that the unparalleled return on invested capital, the free cash flow conversion, and the massive liquidity buffer demonstrate a highly durable business that generic machine learning models simply mischaracterize.
And I maintain that the erosion of operating income leverage we've seen since early 2023 is the canary in the coal mine. When you combine that with total narrative silence on massive debt refinancing and the severe WACC sensitivity, it strips away any illusion of a margin of safety. The business is highly vulnerable to interest rate normalization and unquantified regulatory tail risks.
The complexity of valuing a structurally declining, high-yield, heavily regulated asset is immense. There is a fascinating tension between the pristine cash flow metrics and the alarming narrative footnotes regarding debt and litigation. For our listeners, the next diligence items are clear. Dig into the SG&A, fixed costs, monitor the smoke-free product transition data, and watch the debt maturity schedules closely.
Ultimately, it comes down to weighing the massive quantitative cash flow evidence against the severe qualitative structural risks.
Thank you for joining us for this rigorous intellectual exchange. We will leave it to you, the listener, to form your own conclusion.